Hello everyone. So today we'll be talking about 3 reasons why I don't sell during a market downturn. Before we go ahead, let me introduce myself for those that may not know me. My name is Modupe. I'm not a financial advisor. I'm not your financial advisor. However, I am someone who has invested consistently for the last 15 years, and I would like to share what I've learned from my experience in stock markets around the world. Something I've noticed is when people first start investing, usually you're excited as you watch your investments grow over time. But once you experience a dip, most people panic. The first time they see share prices drop and their portfolios start to reduce, they see that 10 grand that they put in start to become 9 grand and 8 grand, and they start to panic. And the instinctive reaction is, let me quickly sell and pull my money out. All right, let me take it before it reduces further. I'm here to tell you, in most cases, that's the worst thing you could do. Now, again, disclaimer, I'm not a financial advisor, but I can tell you from my experience. Let me give you the reasons why I'm able to control myself and stay the course. Ignore the noise, ignore the hullabaloo, and just stay the course. Make sure you watch to the end because I have one bonus reason for you. So reason number 1 is I know what I am invested in, all right? Now, when people hear investing in stocks, it seems very abstract to a lot of people. To most people, it's just, oh, I'm buying stocks, because you can do it online. You can do it on the internet and just click a few buttons here and there and you bought stocks or you bought an ETF. So to a lot of people, it doesn't feel like a tangible thing. That's why some people don't see the difference between buying shares and buying crypto, because to them, it's the same thing. You open an account, you click a few buttons here and there and you bought it. But there's a huge difference. There's a world of difference between buying crypto and buying shares in a company. And the hint is in what I just said. What you're buying when you buy stocks or buy shares or ETFs is you're buying a portion of an organization. It's not an arbitrary thing in the air. It's not virtual. You are buying a portion of the ownership of a company, a real company that has employees. In some cases, they have buildings, they have offices around the world. Imagine it this way. When you buy shares in a company, it's like you go to your office and you've signed a document with your CEO, and now you're now a part owner of that CEO. While you may not be directly on the board of all the companies you bought, you have a stake in that organization. You have a stake in the ownership of that business. They can't make decisions without consulting you. They do consult you. They consult you through your broker. That's why if you use Trading 212 every now and then, you get emails saying, do you agree with certain things? Or how do you vote on certain topics? So what I'm buying when I buy shares in a company, I'll get to ETFs later. What I'm buying is not some virtual thing. It's not some virtual asset. It is ownership of an organization. And I know that if the price that other people are willing to pay to get ownership of that organization drops, it does not remove the value of the organization. The company is still there. If Amazon's share price drops, let's say they announce something, or Disney, for instance. Disney did something a couple of months ago. They got someone fired and there was this backlash. A lot of people started canceling their subscriptions to Disney Plus and their share price dropped for a couple of days. It's just the amount of money that people are willing to stake in the future of Disney that reduced. Disney is still there. The company didn't reduce its value. They didn't sell assets because their share price dropped. Nothing changed. What changed was just how much people were willing to pay to be part of that company. It was just a sentiment. That's why if you read the book, The Intelligent Investor by Benjamin Graham, he's the person that Warren Buffett trained with. What he says in that book, he refers to the stock market as Mr. Market. Look at it this way. Assuming your house is the company, and Mr. Market is the price of the market. And he shows up to your house every day and he says, today, this is how much I'm willing to buy your house. Then he comes again tomorrow and offers you a lower price. Then he comes again the day after that and offers you a higher price. Does it change the value of the price of your house, the value of your house? No, it doesn't. Your house is still your house. The value of your house hasn't changed because some guy shows up at your door and offers a different price every day. So that's exactly how the stock market is. The value of those companies, those businesses, hasn't changed in real terms because the price that the market is willing to pay for it. So if, like some people you invest in individual companies, the value of those individual companies doesn't go up and down because the price that people are willing to pay for it goes up and down. So when there's a market crash and the stock prices of all these Google, Amazon, all these huge companies, their prices drop, I know that Google, the service is still there. I know they still own Gemini, which has huge potential. They still own like 60 to 80% of the search business globally. Even if people stop using search, they still own the Android ecosystem, which runs most of the phones on the world, right? So the value of Google doesn't change because their price changes. The same thing with Disney. Consider all the IP that they own. Those IP, intellectual property, those movies, the entire MCU IP belongs to Disney. The entire Simpsons catalog belongs to Disney. Family Guy, Fox belongs to Disney. ABC, Sports, they own all those assets. The value doesn't evaporate because people boycotted Disney. It may hurt their share price briefly, but I'm not worried as a shareholder. I may even boycott them as well, right? But it doesn't affect the fundamental value of the company. So for that reason, if there's a market crash today, it has no impact on how I feel about the company or whether I should buy or sell. So that's the number one reason why market crashes don't faze me, and it shouldn't faze you. Number two reason is when I select companies to invest in, I tend to select companies with good fundamentals. So when I select individual stocks to invest in, I know that these are companies that have consistently made profit in the last 5 to 10 years, consistently grown their profit over the last 5 to 10 years, consistently giving out dividends. These are companies that have significant assets. Even if the company disappears tomorrow, their assets are still going to be standing. I know I bought for a price that is reasonable. I didn't overbuy. I didn't buy when the company had already exploded and become big. I target companies that have all those fundamentals in place and are still selling at good prices. So because of all those reasons, I've mentioned my criteria in a number of videos on the channel, but because of all those reasons, I'm not worried when prices drop or anything, because I know the company will still be there. Some companies do fizzle out, right? Some companies do disappear. So it's not every single company that is going to be around in 10 years. Some companies will fail, especially smaller companies. Statistically, most startups do not survive 10 years. A lot of companies actually fail. The funny thing is when you check out some of the biggest companies today, they evolved in their form over time. Toyota is a huge car company today. It started off a paper company, if I'm not mistaken. I think Berkshire Hathaway, Warren Buffett's company, started off as a paper company as well. Actually, I got that wrong. The two of them actually started in textiles, right? So Berkshire Hathaway, Toyota, they both started in textiles. And now Toyota is a car manufacturer, Berkshire Hathaway is in finance. So if you think about it, Toyota could have folded it up as a textile manufacturing company and rebranded as a new company that does cars. They just essentially kept the same name. My point is, a lot of companies don't last long. But the few that do last long, if you're able to identify companies that last long, again, full disclaimer, I don't recommend this for inexperienced investors, but I'm just using this to explain why I feel confident when the market drops. As a matter of fact, that's when you even see me buying more. What do they call that thing? Buy the dip. That's when you see me buy the dip. The market is dipping, I'm buying it. Because for me, I'm getting great companies at a good price. So what if you don't select individual companies? That takes me to the third reason why I don't panic. The third reason why I don't panic, even when I'm investing in ETFs. Now, over half of my portfolio is in ETFs, right? And it's even increasing. It's just a few individual companies that I had bought with trading to 1 to 2 that I still hold on to. But the bulk of my portfolio is in ETFs now, ever since I started using Invest Engine. So if, like me, you also invest in ETFs and you're not checking the books for individual companies and buying them, how do you know that the ETFs would survive another 10 years? Easy. It's even better than selecting individual companies. Do you know why? Because like we just said a few minutes ago, chances that an individual company will crash are a lot higher than the chances of the entire market crashing. Because you could invest in Nvidia today, and then 6 years from now, a new company comes in, Intel gets their act together, and they actually start to give Nvidia some serious run for their money. Or some Chinese chip making company just shows up the blue, and they can actually make the same AI chips for a tenth of the price, and all of a sudden Nvidia is nowhere. But if you invested in a chip making ETF, for instance, or if you invest in a global ETF, it will capture both Nvidia and the Chinese company within it. Unless that Chinese company is not listed in the market, it will capture it. Whichever one of them grows, if one crashes, the index that the ETF is tracking, it will be refreshed, right? So the overall ETF itself will continue to grow. Bottom line, you're actually safer, quote unquote, than someone who invested in an individual company. So that's another reason why, whether I'm buying individual stocks or I'm buying ETFs, personally, I don't worry. Reason 2 is why I don't worry about individual stocks. Reason 3 is why I don't worry when I buy ETFs. So I said I was going to give you 3 reasons, but here's the 4th one as a bonus. So the 4th reason why I don't panic when there's a stock market crash is that I know that I'm investing for the long term. So my investment horizon when I'm investing in the stock market is nothing less than 3 years out. And that's how I see investing. If it's funds that I'm going to need in less than 3 years, then I know definitely I'm not putting it in the stock market. What this allows me to do is that I put that money in stocks. The stock market crash of last week doesn't affect my portfolio of 3 years from today. So I'm not worried, because a lot will still happen between now and 3 years out. I'm not worried about stock market crashes today because I expect that the market would have recovered in 3 years. I'm not checking the news every day to see what Donald Trump has just done or what Keir Starmer has just done, because I know probably by the time I actually want to use that money that I'm investing today, neither one of them will be ruling the UK or US. So that's the thing. Once your investment horizon is long term, then you can invest with peace of mind and not worry about any such thing. The thing to also remember is that the value of your stock portfolio is only crystallized when you sell the stocks you've bought. So if we use the analogy or the example of Mr. Market that shows up to your house to offer a price to buy your house at, the offer that he makes you does not change the value of your house. What changes the value of your house is the price at which you actually sell it. Let's say you bought the house at 100 grand and he shows up tomorrow and offers you 90 grand. It doesn't change the value of your house. So it doesn't mean your house is now worth 90 grand. No, that's just what he has offered you. If he comes the day after and offers you 150 grand, it doesn't mean your house is now worth 150. That's just what he has offered you, right? It is the day you decide, I want to sell my house now. It is whatever he offers you on that day. That is the value of your house. Same thing with stocks. It is the day you decide, okay, I want to sell the shares now. I want to sell some of my shares now, right? How much is now the value of VWRL or S&P 500? How much is it today that I want to sell? That is when you are crystallizing those gains or losses that you've made over time. And the beautiful thing is, if you're investing for the long term, more often than not, at least in my own experience, I can speak for myself, in my own experience, more often than not, when I look back at my portfolio 3 years back or 5 years back, when I look at the value, I always see a growth. There would have been ups and downs, dips and falls, but like I like to say, the stock market goes up and down, up and down, up and down, but generally trends upwards. What I even do sometimes is, apart from looking at the overall growth in my portfolio over that 5-year period, I also divide that growth by the number of years so I can get an idea of the average growth year on year, and I'm usually happy with what I see. But that's when you think in the long term. So that's my 4th reason why I never panic sell. So I hope you found that helpful. If you did, please like this video and comment below. I'll link another video here where I talk about investment timelines and types of investments. For instance, if you actually have less than 3 years that you want to invest, what options could you consider? Or if you want to go way beyond 5 years, you're looking 10 years into the future and so on, what options could you consider? I'll link that video right here. Thanks for watching till the end. Do try to practice the things that we talk about, because it's not just about gisting about money, it's also about making our money grow. Have a good one.